G'day Year 11 and welcome to another YouTube lesson. Today we're going to be taking a look at the third business function, which is finance. And this is part of the management process subtopic, part of the business management topic itself. We've already taken a look at marketing last lesson and operations in the first lesson. Preceding that was looking at the coordination, the interdependence of all these business functions. Next lesson, we'll take a look at the last of the four business functions, which is human resources. Now, before we get into finance, we'll be taking a look at cash flow statements, income statements, also known as profit and loss statements, and we'll be looking at balance sheets as well. All right, finance. This is the business function that concerns itself with money, capital, and how to raise capital. It works well with all other business functions because they require finance in order to operate. And this is that interdependence, that merging of each of the business functions that I've mentioned throughout this section of YouTube clips. Okay, without finance, marketing does not have the money to be able to run its campaigns. Without finance, human resources does not have the money to pay their workers. Operations requires enough cash, capital, coinola, whatever you would like to call it, to be able to purchase their technology, their equipment, their machinery, and also in relations to operations, they need the coin to be able to pay the human resources to work inside the business. Now, finance needs all of these because if things aren't marketed well, then it doesn't generate income on its income statements. If operations doesn't have the money to be able to do their jobs, then nothing is made and therefore nothing can be sold. And it's going to have a massive impact on the finance business function. So you need to understand what each of these business functions are, what each of them do, and how they rely upon each other, that interdependence. All right, cash flow statement. We're going to go through lots of these in class, but I want to make sure you understand the difference between these three financial statements. They're very important for Year 11, but equally, they're super important for Year 12. A cash flow statement shows the movement of cash receipts, inflows, that's money coming into the business, such as money from sales and cash payments, and also it shows the cash outflows, money going out of the business. So it goes. Cash flow statements are vital for the business to assess whether money inflows can match the money, the outflows going out of the business. Now we need to understand this important term called liquidity. The term liquidity is often used to describe whether a business has a good or adequate cash flow. Note, for a cash flow statement, I want you to get this image in your mind. And each of these particular statements, I want you to think of something a little bit different so you can understand how they work and their differences on at least a simplistic level. For a cash flow statement, think of a business's bank account, their standard business bank account. Money comes in from sales and interest earned and a whole range of things. That's a good thing. Then money goes out of the business. You have to pay your bills, you have to pay electricity, you have to pay this and that, wages and so on. So each month, generally, you look at the opening balance of the bank account, then you take a look at the cash outflows, things that are going out of the business in terms of bills, and you also look at what comes in to your bank account each month. Then you have a look at what is left at the end of that. What's left at the last second of January, presto, will be the same thing that's left at the very start of February, and that is your opening balance for the next month. So that closing balance for January is the exact same thing as the opening balance for February. Funny thing is, in Year 11, you often need to do far more detailed cash flow statements than what you do in Year 12. Okay. All right. Now, in terms of the next financial statement, we have an income statement. Income statements are called profit and loss statements. Okay. And in terms of an income statement, they're very important for a business because it takes a look at the income, I guess, the profit or loss that a business makes. So this particular statement, you need to have in your mind, it's going to tell you how much sales you have, how much it costs to purchase the items, and at the end of the day, how much profit you're making. The previous one, the cash flow statement, doesn't go through and talk to you about profit. It just takes a look at your bank account. This one says, right, dude or lady, whoever's owning the business or the owners, how much profit are you making or losing? Hence why it's called an income statement. It's also called a revenue statement. And I like the term a profit and loss statement. It is also called because it's telling you how much profit you're making or losing. Now I'll have a quick chat to you about an income statement. Let's say in terms of your income statement, you're making $5 million in terms of sales or revenue. So $5 million bucks, at the top it is. Now, you need to find your gross profit. How do you find that? Well, there's a thing called COGS, costs of goods sold. So if you are a business, a canteen in a school, and all you make, all you sell are Zooper Doopers, those ice block things. All right, and let's say it cost you $3,200,000 to physically buy those Super Doopers. I'm not talking about electricity, wages, paying for anything else, rent and so on. Just the physical cost to buy those goods plus the freightage, the cartage, which is getting it delivered there. That's part of the COGS. And that's the total COGS, costs of goods to be able to then sell them. Again, let's say that's 3.2 mil. It's pretty expensive super duper business, but anyhow. 5 million bucks in sales, must be a pretty massive school. 3.2 million in terms of the COGS. What's your gross profit? Real simple. It's your sales minus your COGS, and your gross profit would therefore be $1.8 million. Now, is that it? Sweet as. Awesome, bro. We've got $1.8 million in gross profit. I think so. Well, we do, but that's not the total profit. That's the starting profit. You haven't taken out all the other expenses. What are some of the other expenses that you need to take out? You take these out and you get your net profit. And that's the one you're taxed on. And that's the one that you make the money out of. Because people don't work for free. You don't get rent for free and so on. Now, there are selling expenses, there are administration expenses, and there are financial expenses that need to be taken out. So there's selling expenses like the advertising. It's a big ass advertising to sell those super dupers. There's sales salaries. So the salaries for the marketing team, depreciation on cars, there's telephones, delivery, and so on. Let's say all of those total $522,000. Okay, pretty big super duper canteen school business, I'm thinking here. Must have about 10 million people going to that school. Now, there's the administration expenses. You have things like office salaries, again salaries, but it's in the office. You have stationery, rent, insurance, and so on. Let's say that totals $485,000. The last type of expenses you will have are financial expenses. Interest, you've got loans out to have this awesome super duper business. $125,000. You've got insurances, leases, and so on. Let's say they total $137,000. Now, in terms of the total expenses, not the COGS, but the total all other expenses, those selling, admin, financial expenses, let's say that's about $1,144,000. All right. How do we find out our net profit? You just get your gross profit, you minus all those other expenses, and what is left over is your net profit. In this instance, you've my maths is correct, and me looking at this statement in front of me, it is $656,000 is your net profit. You're then taxed on that, your business tax or your company tax rate, and that's what's left over after. Net profit before tax, net profit after tax. All right, getting there. Balance sheets. It's very important, as I always say, but it's very important for a business too. A balance sheet is used to help owners keep a watch on their debt and equity levels and compare their overall financial position with that of previous time periods, and also assist with the process of future financial decision making. It is a report that shows the overall financial stability of the business. All right, now there's something that's very important that you guys need to get. There's a thing called the accounting equation. You have on one side the assets, they're equal to a business's liabilities, their loans, plus owner's equity, anything that's left over. So assets are anything that if they're sold, they can be of value. It's equal to liabilities or business loans, plus the money, the capital the business has invested is the owner's equity. All right. Now, as that mathematical assets equals liabilities plus owner's equity, as that math says, the assets need to be equal to the debts, the liabilities, plus the money that the owners have left in the business that they have invested. All right. So what are some things that we see in the assets? Well, firstly, you have current assets. Let's go on this side. Current assets. These are things that you can sell and regularly sell within a 1 year period. It's always a 1 year, 12-month time frame for current and non-current stuff. Current means that you tend to convert it to cash inside a year. Cash is converted to cash within a year's time period because it's cash. So cash is one example of a current asset. Accounts receivable, that's money that you're going to receive from your customers, okay, your trades, all right, that also is a current asset. We've got here too, stock. That's another current asset. That's stuff sitting on the shelves. Non-current assets, we have things that you could sell and get money for it because they're of value, therefore it's an asset, but it's something that's never sold or it's something that's sold at least every few years. Land and buildings that your company owns is a non-current asset. It's a value, but it doesn't get sold and converted to cash within a year period ever really. Fixtures and fittings, that's lights, curtains, all that type of stuff. Okay, that's also a non-current asset. Intangibles, that's goodwill, the reputation of the business, that's also considered a non-current asset. Now let's say that on the asset side, that totals to $500,000. Think of the term a balance sheet. What will the liabilities and the owner's equity equal? Assets equal 500,000. What are they going to equal? Liabilities and owner's equity. $500,000, of course. Yep, 100%. So if you know the liabilities equal, say, 300,000, and the assets equal 500,000, assets 500, liabilities 3, what are the owner equities going to equal? Has to be 200,000 because they've got to 300 plus 200 equals 500,000, has to equal the assets of 500,000. All right, now liabilities. What type of stuff do you see in that? Again, there's current liabilities, stuff that is converted and paid off within a year's time frame, and non-current liabilities, which are something that's there for generally more than a year. So some of those current liabilities include accounts payable. That's money your business needs to pay generally inside a 3-month time period to your suppliers. Bank overdrafts. Now, I'm not going to get into great detail of each of these, but allows you to dip in to your normal savings account and get a little bit more money than you have in there. That has to be paid off every month or so. Credit cards, you know what they are, same thing. You're an idiot if you have your credit card not being paid off for years. Okay, so it is a current liability. A good example of a non-current liability, something you keep for more than a year, unfortunately, is a mortgage. That's usually 10, 20 more years that you have it all paid off for. Now the last one, it's on that right-hand side still. So for you, I think that's the right-hand side. Maybe that's not. Okay, that is taking a look at owner's equity. Owner's equity includes two main things, generally, in our balance sheets, and that is owner's capital and retained profits. So owner's capital is the money that you have invested in the business yourself, and retained profits are any profits that you've kept from the business, from the income statement, for profits that the business has made. Stuff that you have kept for the business and that you have not used for other purposes. All right, guys, thanks again and see you next lesson. Goodbye.